Well, hi, it's Chris here from Hunter Wealth, and welcome to another one of our Meet the Fund Manager investment series. Today we're kindly hosted by Plato. Plato was founded back in 2006 and is very well supported by Pinnacle Investment Management that really run the compliance and the legal, that aspect of the business, allowing the fund managers really to do what they do best, and that's the investment management piece. Today, I am joined by Dr. David Allen, who established the Plato Global Alpha Fund back in 2018, an all-weather long-short fund that miraculously, spectacularly has done in excess of 12% over the relevant benchmark being the MSCI. David also has got 2 decades of international experience, commencing his career back in London with JP Morgan, co-managing in excess of 10 billion funds, but his real passion is the long-short strategy, which is why we're talking to him today. David, welcome.
Great to be here, thank you.
Thanks for having us. Also, David was a professional rugby player back in the day overseas, I believe, and is president of East Rugby Club, searching for another premiership win, perhaps this year. Probably got to knock off the Woodies and the students, but we'll wait and see. And has a PhD in quant finance, so very well credentialed to talk to us about all things markets and Plato, of course. David.
Excellent. Oh, well, thank you very much for having us on. So the Plato Global Alpha Fund, where does it fit in investors' portfolios? It's typically used as the core global allocation. It's very well diversified portfolio, but despite that, it's still generated some fantastic outcomes. As you mentioned, it's outperformed the MSCI World by over 12% per year since the inception of the fund. That means the fund's done about 22.5% total return per year. A big principle that underpins everything we do at Plato is consistency. We don't want to have a fund that's got fantastic returns one year and then bottom of the league tables the next. So just knocking out those singles every day, every week, or every month, and just consistently accruing people's wealth.
So thanks for that. But what is, for the benefit of our customers, a long, short, all-weather fund?
Yeah, no, very, very good question. So a traditional equity fund is what people will refer to as being long only. And all that really means is that you're buying stocks to invest in, nice and simple. The additional way that we generate returns for clients is by going short companies. And what does that mean? Well, it means that if I've done some forensic accounting analysis and I've identified a company where I think fraud may be afoot, we can take short positions, which means we're betting against the prospects of that company. And if that company does indeed go down, that we will make additional money. And we've actually made about half of the outperformance that you generated through identifying challenged companies, lots of red flags, and that's a key part of our arsenal.
With the war in the Middle East, how has that affected your strategy?
Sure. So we take a view of big macro thematic geopolitical risks that they're increasing every year really in terms of their impact that they can have on people's portfolios. So we run 110 different stress tests on our portfolios every day, much the same way as a bank will stress test their loan book. We're stress testing your portfolios. And for many, many months now, we were stress testing our portfolio for what impact a blockade on the Strait of Hormuz would have, a big increase in oil prices, to ensure that if that was to occur, that it wouldn't burn a hole in our portfolios. And certainly a good thing that we've done that, and we've managed to protect capital very well, where we haven't had a month so far this year where we've underperformed the MSCI World.
You mentioned protecting capital. Obviously, capital preservation with our clients is really important, along with some capital growth. So how is that done within your fund to preserve capital?
Sure. So without getting too technical, what fund managers will aim for is to have a low downside capture. And all that means is when the market's going down, we will also go down because we're an equity fund, but if we're doing our job well, we'll go down less than the market. So the downside capture of the strategy since we launched is about 63%. So it is going down a lot less than what the market is doing. And a lot of that comes down to the risk management piece, but also the focus on the short side of the portfolio, companies with lots and lots of red flags. We have 150 red flags that are fully systematized to identify companies that, for when the proverbial hits the fan, they really tend to suffer. And if they suffer, that helps us preserve capital.
These 150 red flags you're mentioning, what are some of the sectors now that are experiencing significant red flags?
Sure. So the software sector is definitely seeing a lot of red flags. Many companies that they have very poor cash flow, very thin margins, and their business models being disrupted by AI. That's certainly a space that is interesting. Particularly a lot of the financing of those software companies has come from the private credit industry as well, out of the US, not so much Australia. So that's definitely an area that we've made quite a lot of money shorting on that side. A software adjacent name that has done well for us of late is Hemnet. So Hemnet is Sweden's REA.com, realestate.com, and that's off, I think, 80% since we shorted that. So a lot of these industries that seem like irreplaceable incumbents are having their business models disrupted.
Are there any other stocks in there that have really contributed a lot to your outperformance, or another one outside that you can...
Yeah, absolutely. So, let's look a bit closer to home for your listeners, and you look at Domino's. Very, their valuation was stratospheric through COVID, and they've really had their lunch eaten, so to speak, by the likes of Uber Eats. There's Treasury Wine, so I like a glass of Grange as much as the next person, but they've made some ill-fated acquisitions into the US, had some very big impairments. Corporate Travel, which is still not trading, they had some false accounts, misrepresented revenue was another great short. So we've had a number of really good shorts in the domestic market.
And if you would explain, your story, your strategy to the man in the street, how do you explain that so that we can sort of understand it?
Yeah, sure thing. What we're looking for in any company are really four things. So firstly, we want a great quality company. Okay, and we look at that in a whole range of different ways. But most quality companies, they trade at quite rich valuations. Okay, so that's not what we're looking for. We're looking for the 1 or 2 companies out of 10 that's a really high quality business, but there is a margin of safety there, a discount in there, if you will. That's still not enough for us to invest. These high quality, even undervalued companies can be unloved for years and years and years.
Yeah.
We'll always wait for the sentiment to turn positive before we look to invest. The final hurdle is the red flags. So a company, ideally on the long side, will have a very low number of red flags. The short side is the mirror image of that. So we're looking at low quality, commoditized businesses, stretched valuations, poor sentiment, and a high number of red flags. So, for a layperson, say you're buying a house, what are you really looking for? You want a great quality home, okay? You don't want to overpay, so the value's got to be there. You're looking at trends in the economy, trends in the local area. Is that in your favor? So that's the sentiment. And of course, you're looking at red flags. There's a big development going up next door. Are there neighbors or termites and these sorts of things? So it's very much a common sense approach that I think resonates with most people.
And just this 150, 50, how does that work exactly?
Yes, so a normal traditional fund that you'll see in the market has, you have $100 and you just buy $100 worth of stocks. Nice and simple. For us, what we do, we buy $150 worth of stocks. Okay, so that gives us 50% more firepower on the long side to generate great returns for you. But we also have this $50 short at all times. Okay, and most managers in Australia that have tried their hand at shorting haven't really been successful. They've tried going short CBA and just watched the price march higher and higher.
And it has.
Yeah, and it has. But the short component has generated around half of the outperformance for us. So that's a critical part of our competitive edge, and it's the 150 red flags that really allows us to do that.
Fantastic. And then if you had your crystal ball, how do you see this year playing out, and can the Beasties win the premiership?
So crystal ball in terms of markets, a lot of people expect that, I'm a global equities manager. I'll get up and just always give the bull case for global equities. But I think, it's the right thing to do to be as balanced as we possibly can. I think there is short-term risk to the downside. I think markets have been a bit too sanguine about Trump and the disruption that's causing within the Middle East. Hopefully I'm wrong within that, but I think there is some short-term risk to the downside. We don't engage in market timing though. The old adage that time in the market always beats timing the market, that we absolutely subscribe to that. As for the beasties, well, the boys and girls have been training very hard in the off season. We've got a big local derby this weekend against Randwick, which will be a cracker. Yeah, always a Coogee Oval. That's been a bit of a graveyard for us, so fingers crossed we'll go right.
Well done. All right, well, there's a real point of difference with the Plato Global Alpha Fund. If you'd like some additional information on that fund or to update us on your personal circumstances, please give us a call on 9003 40 100 and look forward to catching up with you next time. Thank you very much, David.
Good man. Thank you.
Cheers.